Before there were banks, there was a problem. Not a small problem, not an inconvenience, a structural problem that made large-scale commerce almost impossible. Merchants couldn't move wealth across distances without risking everything. Farmers couldn't borrow against a future harvest. Governments couldn't fund armies without physically holding enough gold. Every transaction required the physical presence of value, and physical value could be stolen, lost, destroyed, or simply too heavy to carry. The bank was not invented because someone wanted to get rich off other people's money. It was invented because the economy had outgrown the infrastructure available to run it. The system needed a solution, and the solution it produced was one of the most consequential institutional designs in human history. To understand why banks exist, it helps to start with the single problem they were built to solve. That problem is called the double coincidence of wants. In a barter economy, where people trade goods directly for other goods, two things have to be true simultaneously for any transaction to work. You have to have what I want, and I have to have what you want, at exactly the same time, in exactly the same place, at a scale that made sense to both parties. The mathematical probability of that alignment happening consistently across a large and complex economy is essentially zero. Barter systems collapse under their own complexity the moment an economy grows past a certain size. The first solution was commodity money, a widely accepted object, gold, silver, grain, salt, that everyone agreed had value. Now, a farmer could sell grain for gold, carry the gold across town, and exchange it for tools. The double coincidence of wants problem was solved, but a new problem emerged immediately. Physical commodity money is heavy, difficult to transport, easy to steal, and impossible to scale beyond a certain point. You cannot build a continental trade network on the back of coins being physically carried from place to place. This is where the first proto-banks appeared, not in the form most people imagine. The earliest banking functions were performed by grain warehouses in ancient Mesopotamia around 2000 BCE. A farmer would deposit grain into a warehouse. The warehouse would issue a receipt. That receipt could be traded, transferred, used to pay debts. The grain stayed in the warehouse. The receipt traveled in its place. This was the first separation of physical value from the representation of value. It was the foundational insight that every modern bank still operates on. The next evolution was the goldsmith. In medieval Europe, wealthy individuals stored gold with goldsmiths, craftsmen who had secure vaults. The goldsmith issued receipts for the gold deposited. Merchants quickly realized these receipts were easier to use than the gold itself. They began trading the receipts directly without ever touching the underlying gold. The goldsmith noticed something important. At any given time, only a small fraction of depositors came to retrieve their gold simultaneously. Most of the gold sat in the vault unused while the receipts circulated. This observation produced the single most important and most misunderstood mechanism in modern banking: fractional reserve lending. The goldsmith began issuing more receipts than there was gold in the vault. Not recklessly, carefully, based on the observed pattern of how often depositors actually retrieved their gold. If experience showed that 10% of depositors withdrew on any given day, the goldsmith could safely issue receipts representing 10 times the actual gold held, as long as the pattern held. This is not fraud in the mechanical sense of the word. It is a calculated management of statistical probability. It is also, structurally, exactly what every modern commercial bank does today. From the system's perspective, this design solved a fundamental constraint of physical economies. Value was scarce not because resources were scarce, but because the representation of value was scarce. By allowing receipts to exceed physical reserves, the system created new purchasing power, new capacity for economic activity from existing deposits.
Credit was born. And with credit came the ability to fund projects, build infrastructure, start businesses, and grow economies at a pace that physical commodity systems could never support. The formal bank as an institution emerged from this foundation. The Bank of Amsterdam, founded in 1609, was among the first true public banks. A centralized institution that held deposits, issued standardized currency, and facilitated large-scale international trade. The Bank of England followed in 1694. Its founding was not driven by abstract financial philosophy. It was driven by a specific government need. England needed to fund a war against France and had exhausted conventional revenue sources. A group of merchants agreed to lend the government £1.2 million in exchange for the right to incorporate as a bank. The government got its war funding. The merchants got a legally protected banking franchise. This transaction, government authority exchanged for financial capacity, defined the relationship between sovereign states and banking institutions for the next 3 centuries. From the system's perspective, the bank is a mechanism of transforming idle deposits into productive capital. Money sitting unused generates nothing. Money lent out funds businesses, builds infrastructure, creates employment, and returns interest. The system is designed to keep value in motion. From the individual's perspective, the same design looks different. The money deposited feels like it belongs to the depositor. It feels like it should be sitting in the vault, waiting. The reality that the bank has lent most of it out to other parties and holds only a fraction in reserve feels counterintuitive at best and alarming at worst. This mismatch of intuition and mechanism is not a failure of banking design. It is a structural feature of a system optimized for economic expansion over individual liquidity. The trade-offs embedded in this design are permanent and unavoidable. The system gains enormous capacity for economic growth. What it accepts in exchange is fragility under stress. If depositors lose confidence simultaneously, if enough people try to withdraw at the same moment, the fractional reserve system cannot meet the demand. This is a bank run. It is not an accident or a malfunction. It is the predictable consequence of a system designed around statistical probability rather than guaranteed individual access. Banks were invented to solve a real problem, the problem of moving value through time and space at a scale that physical systems could not support. They solved it. And in solving it, they created a new kind of infrastructure, one that the entire modern economy now runs on, whether or not the people inside it understand the mechanism beneath their feet. The vault is not full. It never was. And the system was designed that way from the beginning.